Hello and welcome. Today, we're going to get our hands dirty with one of the most fundamental skills in accounting, how a business actually keeps track of all the stuff it buys to sell. It's a crucial skill, so let's jump right in.
So, just for a second, picture a big store. Thousands of different products on the shelves. Or think about a website like Amazon. How in the world do they keep track of what's coming in the door, and more importantly, what it all costs? Well, that's exactly the puzzle we're going to solve today.
First things first. Before we can start tracking anything, we need to be super clear on what we're even talking about. So what exactly is merchandise?
Okay, so here's the key. The definition isn't about the item itself, it's about the intention behind buying it. Think about it like this. A furniture store buys a beautiful dining table. If they put it on the sales floor to sell to a customer, that table is merchandise. But if they buy that exact same table and put it in their break room for employees to eat lunch on, it's not merchandise. It's a fixed asset. It's all about the plan to resell it for a profit.
All right, so we know what merchandise is. Now, how do businesses actually track all of it? Well, there are two main ways they do this. Two different systems. So on one side, you've got the periodic system. This is kind of the old school way. A shop buys and sells stuff all month, and they don't really track each individual item. Then, at the end of the month or year, they do a big physical count. Okay, everyone, let's count everything in the warehouse. It works well for businesses with tons of small, cheap items. On the other side, we have the perpetual system. This is like a live feed of your inventory. Thanks to computers, every time something is sold or a new shipment arrives, the system updates instantly. It's perfect for places that sell big-ticket items, like a car dealership. You really want to know exactly how many cars you have on the lot at any given moment. Okay, now for the fun part. Let's get down to brass tacks. We're going to walk through exactly how to record the most common types of purchases. This is where we stop talking theory and start doing the actual accounting.
We'll start with the most simple and direct transaction there is, the cash purchase. You want the goods, you pay for them right then and there. Easy, right?
All right, let's break this down. On January 1st, the company buys 500 dinars worth of goods, so the purchases account goes up by 500. That's our debit. And our cash went down, so we credit the cash account for 500. Simple. Now look at the 15th. We buy 900 dinars worth of stuff. So again, we debit purchases for the full 900. But this time, we paid with both cash and a check. So we credit cash for 450 and checks payable for the other 450 to show exactly where the money came from.
Now this one happens all the time in business. It's the classic buy now, pay later. Instead of our cash going down, we create a little IOU. In accounting, we call this liability accounts payable. So here's what that looks like. On March 9th, we buy 400 dinars worth of goods from Sod Stores. We debit purchases, just like before, but we didn't pay cash, right? So instead, we credit accounts payable Sod Stores. That entry is literally us saying, we now owe Sod Stores 400 dinars. Same thing happens on the 10th with Sod Allah Stores. The really important thing to see here is that our inventory of goods went up, but our cash hasn't changed at all, yet.
And here's part 2 of that story, paying the bill. On March 20th, we pay off our debt to Sod Stores. To get that IOU off our books, we now debit their accounts payable account for 400. That clears the debt. And of course, we credit cash because the money has now left our bank. Then on the 28th, we settle up with Sodalala Stores. We debit their account for the full 300 to wipe the slate clean and credit cash and checks for how we paid. See, we've come full circle.
Okay, here's a slightly trickier one. What happens when you agree to buy something and you pay a small part of the price up front, a down payment, but you don't actually have the goods yet? How do you record that? So in this first step, we pay a 200 dinar deposit to Samir Stores. Now, notice something really important here. We have not received any merchandise, so we can't debit the purchases account yet. Instead, we debit the supplier's account, Samir Stores, to show we've basically paid them in advance. And we credit cash because that 200 dinars is gone.
A couple of weeks later, voila! The truck arrives with our stuff. The total value is 900 dinars. Now is the moment we officially make the purchase on our books. We debit the purchases account for the full 900, and we credit Samir's Stores account to show we owe them the full amount for the goods we just received.
All right, it's time to pay the rest of the bill. Let's just do the quick math. The total purchase was 900, and we already paid that 200 deposit. So 900 minus 200 leaves 700. On April 25th, we debit Samir Store's account for that final $700 to clear our debt completely, and we credit cash and checks for how we paid it. And just like that, the account is all settled up. Of course, in the real world, things don't always go perfectly. What happens if the goods that arrive are damaged? Or they sent you the wrong thing? And what about all those extra costs, like shipping? Let's look at that. So you basically have two options when there's a problem. A purchase return is exactly what it sounds like. You pack the stuff back in the box and you send it back. A purchase allowance is a little different. That's when the supplier says, look, I know that shipment is a little banged up. How about you just keep it and I'll give you a discount?
Let's look at how we record these. In the first example, we send something back and get a 200 dinar refund. So our cash goes up, we debit cash. The credit goes to this special new account called Purchase Returns and Allowances. Now this is super important. This account gets a credit, which is the opposite of a normal purchase debit. In the second case, we returned goods that we hadn't even paid for yet. So instead of getting cash, we just lower the amount we owe to Khalid. We debit his accounts payable, and again, we credit purchase returns and allowances.
You know, the price on the supplier's invoice is almost never the true final cost of getting an item. You've got to pay for shipping, maybe some insurance while it's on the truck, or even storage costs. We call these purchase expenses.
This is how you get a real picture of what your inventory actually cost. The goods themselves were 2,000 dinars, but then we had to pay 200 for transport, 80 for storage, and 20 for insurance. By recording all these expenses separately, we can see that the true cost to get those goods ready for sale wasn't 2,000, it was 2,300 dinars.
So we've gone through a lot of detail here. Debits, credits, different accounts. You might be wondering, why is it so incredibly important to get every single one of these little entries exactly right?
Well, because every single one of these little transactions we've recorded is like a single Lego brick. On its own, it doesn't look like much, but you put them all together and they build the company's most important financial reports, like the income statement. If you don't track your costs accurately day by day, there's no way you can figure out if your business is actually profitable in the long run.
And really, it all boils down to this one simple, powerful truth. Profit is what's left over after you subtract what it cost you to get an item from what you sold it for. If your purchase records are a mess, then your profit number is basically just a guess. So the big takeaway here is that accuracy isn't just a nice-to-have, it's everything.
So, we have totally nailed how to record everything that comes in the door. But that's only half the story, isn't it? The whole point is to sell this stuff. So, the question I'll leave you with is this. Now that we're experts on tracking the ins, how do we track the outs? But we'll have to save that for another time. Thanks for joining me.